Welcome everyone to the credit analysis and lending video. Please note that we will be talking about how to analyze the worthiness of a loan seeker and thereby go ahead with approving or disbursing the loan amount. So when financial institutions makes loan, returns generated means return accepting certain default risks, certain built-in risk. What is the default risk if the loan is not been repaid fully? So you stand to lose your capital, right? Or the loan amount. It is imperative that the default risk is managed so that the solvency of the bank is never ever threatened. Should the problem of loan be foreclosed or should it be actively be managed? This is again a question because if it is foreclosed, you start to lose a far greater income that could have been accrued through interest. Or should it be actively managed to ensure that yes, we are going for a optimizations of our loan amount and probably we are going to get more of an interest per se. So that is the question that we need to answer it. Causes of default. Default does not, I repeat, does not necessarily mean that all loan extent is lost. Default is defined here as a loan where repayments are overdue. Better lending procedures can minimize, but probably can never eliminate the risk of default. Harder to manage the default risk as a loan book becomes larger than in there. And how do you go across with it? Why should we define it? So that is what default is all about it. Likely causes of default: lack of compliance with loan policies, lack of clear standards and excessively lax loan terms, excessively lenient loan terms, inadequate controls over the loan officers, loan growth exceeding bank capabilities, inadequate problem loan identification, insufficient knowledge of customer finances, and lending in unfamiliar market as on when on basis. And that is the causes of default as the case might be. So yes, this is what we are dealing with, and this is how we are going to go around with it. Extents of the problem loans. All bank experiences bad debts. All bank experiences bad debts, but management of them becomes much more critical. So banks should consider the timing of the loan. In an economic cycle, if the economic is in recession, do you want to give a loan? Probably you don't stand to gain much in a loan altogether. In all probabilities, the loan will become a bad debt. Larger exposure to an individual borrowers. If you think that individual borrower has taken a lot many multiple number of loans, will he be able to service all his loan amount? Again, no. Larger exposure to a single sector. Probably, oh, this is akin to the proverb as putting all your eggs into one hat. If the sector crumbles down, you are gone for a toss. Close monitoring of exposure during unfavorable economic period is what banks should be considering it all about it. The business cycle. The business cycle characterized by three phases: one, two, and three. The first is recovery. The second is boom. The third is downturn. So recovery phase and the expansion phase, wherein the flourishing of economy is increased by spending and leading to a higher deposit, to a higher interest rate. Boom is where the major asset inflations with businesses overconfidences and declining credit standards. And downturn is where we are declining the assets value. The economic activity generally is accompanied by increasing default cases as it happens. So problem loans, provisions and the regulatory issues. When borrowers misses payment, two question arises within the lending institution. Is missed payment a temporary affair? Or is missed payment likely to be an ongoing affair, perhaps leading to the permanence of the sin? You need to understand this. If borrower missed payment, two questions arises, and these two questions are very important. So, if payments are due for more than 90 days, approximately 3 months, loan is considered an impaired asset, as returns of loan may not be achieved. Similarly, values of impaired loan must be downgraded and duly published in the statement of financial position thereby. So we are talking about APRA, the American Prudent Regulation Authority, if I may say so. What are we looking at? It can be your Prudent Regulatory Authority or anybody's regulatory prudent authority, perhaps, when loans gets impaired, APRA will be enacted upon it. So when loans are impaired, institutions must create provisions for losses of loan. Provisions are classified again in three ways: specific provisions, general provisions, and bad debts to be written off completely. So we are looking at specific provisions. Probably, yes, this loan is impaired, but we have some amount of hope that this loan will be recovered eventually after a passage of time. Then there are general provisions as what needs to be done to ensure that the repayment has to be done. Probably there is some things that have been mortgaged. You need to take control over it, and bad debts probably you cannot do anything without about the loan. So specific issues. These are provisions set aside for specifically identifiable loans where the institution can assess the condition of the loan, the conditions of the borrowers, and the impact of the economic event per se. Not all loan must have provisions made as lenders may assess the likely loss of from the asset thereby. This is what we need to understand every now and then. The general provision, these are the provisions that made as a proportion to the entire loan portfolio. Suitable, remember, suitable for large loan portfolio of similar asset, example mortgages, where specific provisional is unsuitable. APRA is the American Prudential Regulatory Authority. Generally, minimum provision is 0.5% of the risk-weighted assets. Can adjust a general provisions level depending upon the economic activity or perhaps the risk level that one is undertaking. Bad debts, recognition of the bad debts occurs when all security gets liquidated. Guarantees has been enforced. Remedial functions, actions has been explored, and no remaining sources of cash can be called as on when-on basis. Once the above steps are completed, the financial institution must write off the bad debts with the assets value at zero and a charge being made against the profit then and there. So regulatory issuance, the APRA guidances which governs the bad debts. It might be certain sections that we are speaking around it, but just to give you an idea, Category One is registered first, and second mortgages with LVR, which is less than 80%, have no provisions altogether. This is what you need to understand. Category 2 is everything same as Category 1, but where LDR, LVR is all about 80 to 100% altogether. Next is what we call the Category 3, same as Category 1 and 2. Same as 1 and 2, you need to have an LVR, loan to value ratio, is more than 100%, absolutely declining assets value. So please understand, in category 1 the LVR is less than 80%. In category 2 it is in between 80 to 100%. LVR stands for loan to value ratios, as in what we are looking into it, the value that has been mortgaged. Category 4 covers overdrawn revolving all types of facilities where longer default periods produces higher provisioning requirements. The provisions made minimizes the efficient use of capital that could otherwise be used for lending purposes. Institution having the provision exceeding APRA, the American Prudential Regulatory Authority requirements to reflect the bank risk and profile. Higher provisions indicates higher amount of risk and more conservative management. Lower provisions indicate lower risk and more aggressive management, as the case might be. This is what we are looking forward to. Dynamic provisions is the risk profile of the loan portfolio is sensitive to the point in the economic cycle. The greatest default occur at the bottom of the economic cycle when it is at recession. Therefore, credit risk is not static but changes over a period of time. Bad debt should not come as a surprise, as modeling should detect changes. It should probably look at the default risk in the portfolio segment altogether. Dynamic positions, as far as the key principles are concerned, you need to classify loans in homogeneous groups, subclassify the groups based on the maturity length, determine probability of loss for each of the groups. determine likely severity of loss for each group thereby. Use the historical loan loss informations to create predictive model incorporating economic condition, interest rate, investment activity, and thereby apply the model outcome to the current provisions as on when on basis and how do we go across with it. If the loan is in a default, bank must act to minimize the losses arising from defaulting clients, may reschedule payments rather than liquidating the loans. Classify defaulting clients into three categories: the mild financial distress, the moderate financial distress, and the severe financial distress. Something on mild levels, moderate level, and severe levels of distress that goes around it. Remember, mild financial distress often occurs when the borrower faces a short-term cash flow issues. That means there is a late receipt. If the default is less than 90 days, remedies include changing the length of repayment schedules, assisting the firm if the cash flow shortages have risen from a period of rapid growth, encouraging firm to sell non-core assets, requesting and probably demanding equity capital injection thereby. What about the moderate financial distress? Here, you may occur if the cash flow problem coincides with the borrower's assets going down, the value of the assets going down. Courses of action determined by the nature of collateral. Example, foreclosure of mortgage or support manufacturing firm with unique or limited market risk. Lenders may consider valuations of alternative via NPV, the net present value, or probabilistic models of expected values of for different action that has been taken place. What about the severity when the financial distress is very severe, characterized by complete missed payments? Values of the borrower is much less than that of that loan amount. Lenders needs to be very carefully evaluate whether it is better to give liquidate the firm to recover greatest percentage of loan possible or restructure the debts inclusive of the other lenders to maintain operation, to allow firm to trade out of the current crisis or be sold as a going concern as the case might be. The coordination problem, what happened when numerous classes of debt holder observes syndicate loans, any scheduling will require cooperation from every debt holders need to restructure debts to ensure all debt holders are treated equitably, or else rescheduling proposal will falter, will not be successful. That is what we need to go around with, that coordination problem. Other breaches. Corporate loans may have other varied covenants imposed to protect loan quality. Lenders may place a variety of conditions to strengthen the loan repayment probability. Let's say no excessive withdrawal or cash flow. Risk profile of the firms to remain absolutely unchanged. Specification of the various ratios including gearing, dividend payout, and interest coverage. Continued involvement of key staff. Application of the risk management strategies as on when on basis. Now these are things that needs to be stipulated, mentioned, regulated directly. Examples from the law, as in winding up a general performed by registered liquidators who sell assets for the benefits of the creditor. State Bank of Victoria relied on the collateral sophisticated rescue equipment stored in the barrels. Barrel empty and not worth $250,000 as noted, but only 1,592 each. Information supplied by Harris Scarf and HIH Insurance grossly were inaccurate, and a little collateral available when default actually occurred. This is what the glorifying example is all about it. So keep in mind when we are giving loans and how do we protect it. Thank you for watching this video till the end.